Hello, everyone. I'm Ted Oakley, managing partner at Oxbow. And as always, I'm glad to have with us our top favorite speaker I think we've ever had, as far as people keep looking at what she says, Danielle DiMartino Booth, who is CEO and Chief Strategist at Quill. And glad to have you, Danielle.
I'm happy to be here. We're living in some strange times. And my biggest takeaway for today, I hope, is that everybody has an understanding that even though we wouldn't want for it to be the case, right now in America, politics is economics. And it really is as simple as that.
You know, I wanted to ask you, and you start off with a couple of really good slides, but since you wrote your book, which is a fabulous book I would recommend to everybody, called Fed Up, since you wrote the book, I'm assuming you've seen even more deterioration in the Fed, and then what goes on here with what you're talking about here.
Yeah, a lot of it was a slippery slope, especially during the Obama administration. When Greenspan was running the Fed, it was an increasingly slippery slope with the Fed becoming more obtrusive and intrusive in financial markets, with the Fed becoming more accommodating to the will of politicians. And eventually what we got with the pandemic was the effective marriage of the Treasury Department and the Federal Reserve, which, by the way, is against the law. And now we see that we have this extraordinary attempt at coordinating fiscal and monetary policy, and they're kind of doing it right in front of us. And we're watching some of the most conservative, hawkish members of the Fed fall like flies that have emerged in a scandal that is not necessarily what we would think it looks like from looking at it from the outside in, mainly because the individual who's been responsible for years for signing off on the financial documents also happens to be the person who's in the second running to take over Powell's position. Not that we can find that as a matter of public record. So there's a lot of, I don't watch Game of Thrones, but people keep telling me that right now the Fed is like the Game of Thrones. And I returned from Italy, traveling there for a few weeks. I can tell you this is the prince playing out. And what we're seeing is extremely Machiavellian in nature. And the goal is, or the battling forces, if you will, are between using the Federal Reserve as a future conduit to deliver socialism, deliver money directly to the people, rendering the liabilities of the Federal Reserve effectively legal tender, like a dollar bill, versus those forces who want to prevent that, because everything I've just described is about as un-American as you can get.
And so I think you have you talk about this, about the New Deal, and I think people believe that, but you might explain that.
Well, the New Deal was at least fairly productive, and we had a lot of things to show for the New Deal, like dams, the Hoover Dam, and all manner of bridges and tunnels, and that was 40.1% of GDP at the time that the New Deal was being deployed in the U.S. economy. What we've seen come out of Washington is 43.2% of GDP. And the reason I highlight fiscal stimulus to the extent that I do is A, it's the largest in U.S. history, but B, it was required to accompany monetary policy. The Federal Reserve was not allowed to go, was not capable of going at it alone. The last time, Ted, you and I spoke, we looked at a lot of slides about how fragile the corporate bond market is. That hasn't changed. It's just grown in nature. So we've gone from $10 trillion in outstanding corporate bonds in the United States to almost $11.5 trillion. So that problem has just gotten to be bigger. And that was why when there was the black swan event of the pandemic washing up on U.S. shores, the Fed was not able to act alone. It had to have fiscal authorities alongside it at record levels in order to address the flash recession that hit the economy for 2 months in 2020 when the economy was forcibly shut down. The problem with that, if you look at the next slide, which is going over the fiscal cliff, is that there's one heck of a payback And we have gone into a contractionary pull in terms of fiscal policy that is extremely problematic and must be addressed in theory, but cannot be. Because what we're talking about, what's being contemplated right now by the Congress, is infrastructure spending that is spread out over a 10-year period. You're no longer giving people money directly, as in direct deposits, stimulus checks 1.0, 2.0, and 3.0, a gigantic proportion of which went to people who didn't need it, which has generated the inflation that, let me tell you, has made Europeans, as I said, I've just come back, bitter about the level of fiscal stimulus in the United States, the magnitude of it being big enough to cause global inflation. And that's what we've seen.
And let me ask you on that count, it doesn't seem like, what do we have, 3 appointments that are up, that will be up for the 3 that they're out? Is that right, 3?
It's 3 so far. So you've got Boston, you've got Dallas, and these are extensive searches. You've got Quarles, who stepped down, I think, preemptively and on purpose to try and push Brainerd into the position that he stepped away from, which is banking supervision and regulation, which Jamie Dimon would say over my dead body. But Lael Brainerd would rather have the chair position, obviously, but Quarles stepped down. So now you really don't have a head of banking supervision and regulation, which happens to be very important. And you've got Rich Clarida, who's effectively gone silent. He's a vice chair. His term is also coming up just in the next few months. We know that he's leaving. He has, the running joke with me and my friends who understand the Fed very well is that he's shackled and locked up in the basement of the Eccles building because all of Rich Clarida's work, his entire body of work, his entire career has been on inflation expectations. And we have officially crossed that Rubicon in terms of 5-year out inflation expectations, such that he knows very well that Fed policy right now is in complete disagreement with where Americans feel inflation is, and much more importantly, where it's headed. I know the brinksmanship is absolutely exhausting to watch between Pelosi and Schumer and McConnell and Biden. And we used to think that the country was going to run out of money on somewhere in or around Halloween. Now it possibly could be December the 3rd over the weekend. Nancy Pelosi came out on the Sunday morning shows and said that the Democrats, if they have to raise the debt ceiling alone, they're finally considering doing that. And that's good news because McConnell said that come December the 3rd, which is when the next deadline for the debt ceiling rolls about. And the reason I talk about the debt ceiling is because we can recall a few weeks ago when we were like, gee, why is the stock market down 1%, more than 1%? That was all about the debt ceiling and the potential dangers of the U.S. defaulting on its treasuries. So it is a very important thing to watch. We're going to be crossing over into November. The clock is ticking. And the one thing the Democrats do not want to do is to put their names on a $7 trillion increase in the debt limit headed into midterm elections, which are a year from now. So whether we as investors want to pay attention to this, it is an extremely important factor going forward because the country has to pay its debts. So put that on your radar screen.
Right. Well, and you talk a lot about how that's moved over into real estate, particularly people with
yes.
in the home area.
Lacey Hunt, who's at Hoisington Asset Management, they're in Austin. One of my mentors, he has always taught me, Danielle, housing and autos lead economies into and out of recession. It's just the way it works. And when you look back at history, Lacey's correct. Selling conditions for home sellers are the highest they've been on record. They've blown past this first slide, the blue line. They've absolutely blown past anything we saw during the run up to the housing bubble that was so biblical that erupted in 07 and 08. They're past that. And buying conditions are much, much lower than they were back then. And as a result, there's this massive disconnect, extreme divide between where buyers and sellers should be. And that's why you might have noticed in the Wall Street Journal a few days ago, once hot housing markets are turning. we're starting to see price reduced signs. And at the same time, you have home builders who are way over their skis, who have put too many homes, put sewage into too many homes. And why do I bring up sewage at this time of the morning? Well, once a home lot has got the sewage laid, the home builder, public home builder, has no choice but to go up. So after all of these years of talking about the undersupply of housing, we could be in a very fast and rapid cycle right now of too many homes being built at once, even as the economy is slowing, even as the next slide that I've got on home buying conditions shows that the qualifying income for a first-time home buyer is not sufficient for a median priced first-time home. So again, these are levels that now surpass that of the housing bubble years. And it's not so much that we have to worry about the net worth that we've built up in our real estate. We'll get to that in a minute. It's not so much that we have to be concerned about the first-time home buyer can't get in. 25% of homes are being purchased by investors. Why does this matter to us? It matters because housing and autos lead the United States economy into and out of recovery. Cox Automotive has just told us that they anticipate October will be a sixth consecutive month of declining auto sales as well. We've never seen such a situation outside of early 08 and 1 month in 09 during the great financial crisis. So as far as we can see, housing is slowing quickly and autos are in recession. It's more than a semiconductor situation.
Interesting. And I think what happens is people, I used to mention this, but in the 80s, they couldn't buy a house because the interest rates were too high. Now they can't buy it because the house is too high. It's still a high payment any way you want to go. And so I think that's what you end up with. And I see a lot of people really stretching to get into these larger homes and not really having the income to probably get there, to earner families, that sort of thing. But that'll be an interesting situation again.
Well, and I think a lot of these millennials have zero conception of, you can squeeze and squeeze and squeeze to get into this home. Then, they sign everything, the title's in their name, and all of a sudden the air conditioning blows out. And they say, wait a minute. Maintaining these homes is going to be a whole different thing for a millennial generation that's already put off home buying for a decade.
Well, maybe they think they can pay for it with Bitcoin or something. I don't know. We'll see that. But you talk a lot about, too, how that's gone, other areas after real estate has gone over in equity market, household equity ownership, that kind of thing.
Yeah, it's when you look at how concentrated householders' equity is, it is just extraordinary to see the demographics of the stock market. There was a new report out last week. The Federal Reserve kind of parses out who owns what, and the top highest echelon of U.S. income earners now owns 89% of U.S. stocks. Americans who own stocks in general has come down from 60% to 55%. But again, and it is mostly concentrated in those 55 and older. I've got this chart of little red bars shows who owns the stock. And we have to bear in mind that demographics cannot be ignored. We had millions upon millions of extra retirees in the year 2020, people who left the workforce who are 55 and older because their homes are more valuable than they've ever been. The next slide shows you this in no uncertain terms. Equity ownership in household real estate, it's at the highest on record. The value of people's stock holdings, it's at the highest on record. So a lot of millions of extra Americans last year felt confident enough to leave the workforce prematurely. And now we have employers struggling to fill positions with people who actually want to go to work on what we would call a regular basis, kind of a Monday through Friday. We have a generation who found out that working from home is a lot of fun. They just don't want to do it on Mondays or Fridays, or Saturdays or Sundays. And they want to dictate their terms. And the reason I bring this up is because once we've lost this steadily growing cohort in the workforce that we've had for the last 15 years, 55 plus, your work ethic also starts to get distorted and your productivity becomes at risk as well. And yet here we are, and this is one of the prices that we are paying for 43.2% of fiscal stimulus being directly injected into the veins of U.S. workers to not work.
Let me ask you, Danielle, you mentioned earlier about the stock ownership in people over 55, and I think in that graph you had 40% were over 65.
Oh, yes.
And so don't you think that, I remember in the last two really bear markets we had, people were like, oh gosh, I still got a little time. But now I don't think there's much time. So if something happens and you go through a really severe bear market and they have this, and by the way, I cannot get this over to people. They're 70 years old or 80 and they have 85% stock or 90. And I'm like, hey, you need to start thinking here because you probably don't have a chance to go back to work at 75. Don't you think that's an impact?
Ted, you're describing what I call the distinction between optionality and optionality. There was optionality in 2009 and 2010 because the boomers were 10 years younger. So like, you know what, life expectancy is what it is. I just shed 40% of my equity position. That's truly a tragedy. But you know what? 65 is the new 75. Or back it up, 55 is the new 45. There was the optionality to stay in the workforce. But we're 12 years beyond that point now. And the optionality is not there. And if the U.S. is to go into recession, if the housing market continues to turn, which is going to start making boomers nervous because they've been doubly fortified by saying my home is worth more than it's ever been worth and my portfolio is worth more than it's ever been worth, I'm good to go until I'm 95 years old, just based on what my holdings are. But if you start to see the housing market crack, which we are, at the same time that the housing market cracking could be a catalyst, if you will, for people to say, you know what, maybe I should reduce my ownership in stocks. There was a Bank of America fund manager survey that was released last week. They're released once a month that showed that U.S. households' ownership of bonds has never been this low in the history of mankind. Now, I know that bonds are overvalued. I understand that, especially corporate bonds. We could have a whole discussion about that. But at a time when it looks like the Fed's going to commit a policy error by trying to tighten into a slowing economy, that is a time when, believe it or not, your long bond and your 10-year and your 20-year treasury tend to outperform, tend to actually be safe haven places to hide. I know that's probably blasphemy to hear.
Well, that's interesting for sure. I know, and I think you talk a little bit about how things are having an impact worldwide right now, with this whole inflation bottleneck kind of thing that's out there.
I think we all know that Federal Reserve liquidity is the dominant driver of the stock price. And we can't forget that because a week from Wednesday, on November the 3rd, we're going to have the Virginia gubernatorial election results, which could be its own source of instability for the market. We've got Treasury refunding needs being also reported on November the 3rd. They're expecting to announce a reduction in the need to supply treasuries. And then you've got the Fed announcing a taper. So all of these things at one time could be disruptive to markets. And you have to pay attention to that, because the difference between 2017 and how ugly we remember 2018 as being, the difference between the two was liquidity.
Danielle, do you think you'll actually cut back on buying bonds on the 3rd?
I think that, we know that the Wall Street Journal is the mole. And we know that the Wall Street Journal has a planted reporter inside the Fed. It is what it is. Read Fed Up if you haven't. So that particular individual published today that it is a go on November the 3rd. And Powell made a speech on Friday. And Powell basically said, it is a go come November the 3rd. So I don't think that they feel like they have latitude because of this progeny is destiny slide that I'm showing you. These bottlenecks, what's happening not just at U.S. ports, what's happening at European ports, what's happening in the UK, Japan, Australia. There are a lot of striking port workers right now, by the way. These bottlenecks have become biblical. 100 trucking firms in the United States went out of business in 2020. A lot of them had started to go out of business because of the trade war that started earlier than that. But you lose 100 trucking companies and you lose a bunch of truckers. And even if we could unclog the situation at the ports, the problem is there are also too few truckers to pick up those containers from the railheads. And so the situation, Biden has negotiated with the Longshore Union. They're agreeing to work 3 shifts 24/7 for a 90-day sprint to make sure that nobody steals Christmas. But what nobody's talking about is that as high as expectations are for these bottleneck situations to not get unwound over the next 6 months, this particular union, which is one of the strongest in the United States, one of the highest paid in the United States, the last day of their contract is June the 30th. And they're talking not only about demanding the highest wages they've ever seen, but putting the brakes on automation that these ports have desperately been trying to implement to try and unclog the arteries. The reason I bring this up is because it's not just input costs coming down in a potentially stagflationary environment because demand is decreasing. If this shipping situation is to persist, then the Fed's got housing inflation and the freight and shipping situation maintaining at too high of a level. The core PCE, by which it makes policy, forcing it to try and hurry up the taper. Hurry up the taper. No U.S. investor wants to hear that. But if they're hurrying up the taper, that means they're hurrying up the taper so that they can get to some rate increases because they're so far behind the inflation curve.
Right. Yes. Interesting. So you talk a lot about what's going on in the government, in the Senate, and everything that's going on up there as well. And I think everybody has the same concerns about that we really don't have anybody that's actually worried about the U.S. particularly. We don't seem to have anybody that honestly just cares about the country. But you might visit that a little bit.
Well, we're in extraordinary times as a nation. Traditionally, the Democratic Party looked out for the little guy. And traditionally, the Republican Party looked out for its cronies. And I'm paraphrasing here, but while it was looking out for its cronies, it also kept the lid on spending. And now you have the Democratic Party that is basically run by corporations in America and special interests, or we wouldn't have companies in Silicon Valley that have yet to be broken up. We would actually have antitrust in this country instead of the biggest monopolies we've ever seen that make the robber barons look like small business owners. So the Democratic Party is beholden to one area. The Republicans are beholden to Wall Street, but it's the in between. It's the silent majority. It's the Joe Manchins of the world, who the GOP hosted in Texas recently, solely the GOP for a fundraiser. So it is. It's the silent majority in the middle that has seemingly lost its voice. And at the same time, you have individuals like Elizabeth Warren, like Sherrod Brown, like Bernie Sanders, who are trying to corral momentum behind them. There's an Omarosa gal who's been nominated to a position in the comptroller of the currency. Nothing could be worse for the United States. If the progressives are to progress, and I call them regressives, their absolute goal would be to implement a central bank digital currency, a digital account, an account that your average American would hold directly at the Federal Reserve, such that money could be delivered on a regular universal basic income basis to them. And that is why I tell people that this is the moment in U.S. history to stop the slippery slide. And if the progressives succeed in saying all we're doing is creating a conduit by which to give banking to the unbanked, which is a genuine crisis that is undeniable and has to be addressed. You cannot be unbanked and be a hardworking American. That's a no-no too. You shouldn't have to go to payday lenders. You shouldn't have overdraft fees that make it to where you're a month or two behind on your rent. So there's a genuine tragedy there. But using this as a cover to implement a digital currency like the Chinese have would give the US government the ability to monitor every single transaction every American makes. And it would put out of business the conventional banking system.
I think people forget about that too. I've always thought that when you get a digital currency, they're going to own you. They're going to basically be able to see, and people don't realize what that means. I mean, if you tip somebody down at the diner, they'll see it, you know, and
Yep.
that's just the beginning of the end for that matter for freedom. But interestingly enough, and I think everybody has the same concern that you just mentioned about the whole situation there. They just can't get a handle on it. And speaking of that, you do have some thoughts about China and how that's affecting us worldwide too.
I do, but if you wouldn't mind for just a minute going to the Disappearing Jobs Act before we jump to China. And the only reason I want to bring that up is because I look at the current. I don't discount or ignore the wage inflation narrative, the lack of skilled workers. There's an undeniability about it, but the flattening out and the improvement in the jobs market is extremely concerning to me right now because of the magnitude of investment we've seen, especially larger corporations making in automation since the CARES Act was passed in March of 2020. My point is there is the risk of the portion of stagflation manifesting in a lot of jobs never returning. And the example I like to use is White Castle, south of Chicago. It's got Flippy. That's a 23/7. It's got to go down 1 hour a day for cleaning. Flippy makes the French fries 23 hours a day. It's got a friend behind it that flips the burgers 24 hours a day. In the front of it, there's a kiosk that takes the order as opposed to a human being. Now, broaden this out to big America and artificial intelligence, and we've seen an increase in outsourcing all over again. We're seeing manufacturing go to Mexico. So we're seeing a pushback against this idea that the U.S. employee is now in the driver's seat as opposed to the U.S. employer. It's not that there does need to be a better balance between what CEOs and C-suite executives are paid and what workers are paid. And I think that we have seen rational wage inflation. But the idea that this is going to continue ad infinitum, that doesn't work well because of how quickly we're automating. We're automating possibly at the same pace as China, which has a demographic issue on its hands and is using robots more than any other country in the world because of the demographic situation it has from its one-child policy.
But you know, Danielle, on this, talking about this wage thing between the public company CEOs and say the average worker, we don't seem to get anywhere. It just keeps getting worse. In fact, it's the game they all play by buying the stock back and doing that setup. And it's interesting that nobody seems to see it, but it really takes away from the average worker, and I think that's what's hurting us a lot in this country.
I agree, Ted, and as blasphemous as it sounds, there was good reason that share buybacks were outlawed before 1982. I understand that there are good reasons in textbooks. I learned it at UT. There are great reasons for there to be share buybacks if there's no reason to be able to deploy capital effectively and efficiently. But share buybacks have simply become a way for CEOs and CFOs to make sure that executives are being paid on the basis of earnings per share. And all they're doing is pumping up. And that to me is a form of insider trading that is just as nefarious as what we're seeing unfolding at the Federal Reserve and what's been going on in Congress since the history of mankind. Insider trading is insider trading, and none of it should be allowed.
And therein lies the tie between Wall Street and Washington. You throw the SEC, you throw everything in there together because nobody everybody just, they just walk past it. And so that's where we're stuck right now, unfortunately.
We're whistling past our own graveyard.
Exactly. Anyway, you did mention, if it's okay, you did mention something along the lines of how it's not in our best interest just to poo-poo China here, that we are dealing with a force.
So I've got a slide that says what happens in China does not stay in China, and that's obviously a play on the Vegas mantra. China is in a bad situation in that they don't have the ability to generate as much debt as they once did. That means that unlike in 2015 and 2016, when there was an industrial recession, they were able to pump a ton of money, not into just China's economy, but into the global economy and pull the global industrial recession out. And then the Trump trade war began. And things have really changed since then. We forget that China was at a 30-year low in terms of its growth rate in 2019, that world trade had contracted for the full year in 2019. Right now, GDP estimates for China for the fourth quarter are suggesting something along the lines of 5%. That would put it below where it was at the end of 2019, meaning the pandemic was effectively a massive surge of activity into the global economy, created a ton of demand that was pulled forward. And now we're seeing that backlash come down, and the credit impulse and the total social financing flows in China go very, very low. Energy costs are extraordinarily problematic worldwide right now. They're even worse in China as it shuts its industrial sector down in anticipation of the February 5th opening day of the Beijing Winter Olympics. The skies in Beijing have to be clear. And by the way, somebody sent me a photograph of Beijing just yesterday, and the skies are already clear. That's a bit premature, and it tells you how bad the situation is with coal, with energy, with natural gas, with China's being totally dependent upon other countries outside of its coal industry, which is 71% of its economy, 71% of its energy consumption is coal. But having to shut down that coal capacity is having ripple effects across the world. So wherever it's cold this winter, it's going to be very problematic. I'm going to be turning it from somebody who's watching politics and what's going on inside the Beltway to becoming a meteorologist, because the electricity rates and the cost of heating homes could put the entire world into recession this winter. That's a fast-growing risk.
Right. And an unintended consequence, by the way, of ESG. Everybody's this idea that they're going to solve everything within a couple of years, and we keep saying, "Hey, your timeline is way off."
Yeah, I mean, look. I was in Paris for 2 nights on my way home, and I can't tell you how angry people in France are that they're sitting on one of the biggest shell formations in the world, and the 5 biggest French banks have just formed a pact to not finance any form of shale exploration in the country. So there are these disconnects that just make your head want to explode.
So Danielle, sort of in we know all the markets are high in really anything, private business, real estate, stocks, everything. So if you were counseling somebody today with brand new money, how would you go about that?
I think that we're in an environment where you need to have a lot of dry powder. And if you can jump to the slide about stock values being where they are, I don't think a 35% allocation to cash in this environment is unwarranted. I have really enjoyed my municipal bond portfolio. I'm not old enough to even say that, but I've really enjoyed it these last few years, and it's done very well for me. But they're still really expensive. But it is good to keep in your quiver, especially when we see muni bonds trade down as they have recently. It is good to keep in your quiver the fact that it's pretty apparent that the United States government, until we blow up, it's going to hold up Illinois, New Jersey, Kentucky. So there are good places to hide in the municipal bond market. And I also think that gold is the most detested asset class in the world right now, which makes it that much more attractive to me. And at the same time, you have to focus on sometimes the little headlines make all the difference in the world. Nike can't get enough shoes. Nike's stuck in a port somewhere. They can't get what they need for the Christmas season. On the flip side of it, you've got Costco we're going gangbusters. So look for staples, look for companies with strong balance sheets, have your investment advisors look for individual stocks with strong balance sheets, with safe dividends, because in this kind of an environment, having a company with good cash flow, a solid balance sheet, not too much debt, the ability to withstand some capital decline, some decline in that price, but still have cash generation is critically important.
And you know, Danielle, for Oxbow, for example, we do have gold, and we have about that level of cash you talked about. Mm-hmm. And yet people will ask you, why don't you do, and we try to mention to them, well, you know, if you're at this level of things, you can participate with 65 cents on the dollar. You don't have to be participating with 100% on the dollar. And I think people, they forget about that, and then when times come along, and they, you know, and you've been through a number of these, when they test them, then they forget about what they were thinking at the time.
Well, the best analogy, I was on a panel in New Orleans just a few days ago, kind of my first in person, which was very strange and surreal feeling, Ted. But we're going to do this in person one time, Ted. I promise we are. But the best analogy that I heard when it comes to how you should view your cash within your portfolio is as an accordion. And it expands at times when opportunities are decreasing, and the accordion comes back in, and you reduce your cash position when opportunities are more abundant and when valuations are more realistic. And I think that investors should think of their cash position as being this kind of dynamic portion of their portfolio, rather than try and jump in when stocks are 7 times more overvalued than they were at the outset of the last 1920s decade.
Well, it's interesting, and I'll tell you, the information you've given us today is always great. I mean, I'm sure everybody tells me, well, why don't you talk to Danielle for 2 or 3 hours? And we probably could, because you're a wealth of information, and you always are right up on top of everything. And by the way, everyone out there, I would encourage you to use Danielle's services at the Quill Intelligence. I think you will find that it's really interesting. I don't know how you write so well every day, but you do. It's incredible.
I try my best. And Ted, I will say, for anybody who's ever contemplated, we're about to take the professional level of Quill offline. That's going to be in new form. So for the next few days only, I sound like a used car salesman. As of November the 1st, the professional version, which you get, the institutional version, won't even exist anymore in its current form, and prices are going to be doubling. So, okay, now I'm going to have to go take a shower. I feel so much like a used car salesman, but I feel like I had to put that out there because we've grown Quill Intelligence so much. We've grown our product lineup so much. We now tell people not what they should think about the economy, but actually how they should deploy their assets. And that has differentiated us and allowed this company to grow. And I do appreciate the support that I've had from you all these years.
Well, the other thing is, I will say this, you get what you pay for. And I will tell that to everybody, that not everybody on the street will give you the straight skinny, I would say. But Danielle will. And that's what I love about you. And I know everybody else does the same way. And Danielle, thanks so much. We look forward to having you again, though. So appreciate you being here.
Thank you, Ted, for your time.